You are sitting in a dentist's chair. You need a crown, not the podcast, the dental kind. The bill is $4,000. Insurance covers half. The receptionist hands you a little card application and says, Care Credit. What you are really being offered is a credit product managed by Synchrony Financial, a company that processes roughly 80 million consumer accounts across healthcare offices, car dealerships, jewelry stores, and outdoor retailers nationwide.
And on April 21, 2026, Synchrony reported a quarter that told a story of credit improvement, record spending volumes, and a capital return program so large it could retire nearly a quarter of the company's own shares.
EPS of $2.27 versus $2.20 estimated. Net income up 6.3% year over year. Net charge-offs fell to 5.42% of average loan receivables, down nearly a full percentage point from a year ago.
I'm Lana Chen.
I'm Hudson Thomas, and this is Charged Alpha, the S&P 500 stock encyclopedia. SYF is the ticker. Let's dig in. Section 2, Company Overview. Let me set the stage on Synchrony, because I think most investors know the name, but not the machine underneath it.
Synchrony is the largest issuer of private label credit cards in the United States. They were founded in 1932 as a GE Capital retail finance division, so they have nearly a century of consumer lending history. In 2014, GE spun the business off as a standalone public company, and Synchrony has operated independently ever since. Headquartered in Stamford, Connecticut, about 20,000 employees, and a balance sheet with nearly $90 billion in loan receivables.
The business model is deceptively simple. Synchrony partners with retailers and healthcare providers, roughly 500 partners today, and manages the credit cards those merchants offer their customers. Walk into a Lowe's, apply for a Lowe's card, that card is Synchrony. Walk into Ashley Furniture, Synchrony. Go to the dentist and they offer Care Credit, Synchrony.
They organize the business into 5 platforms: health and wellness, which includes Care Credit; digital, which includes online commerce partnerships; home and auto, which covers home improvement and power sports; lifestyle, covering luxury and jewelry; and retail, the traditional store card business. Revenue comes primarily from interest income. Credit cards charge 20 to 30% annual rates, plus interchange fees on every swipe and fee income on the account.
Care Credit is the jewel. Synchrony's healthcare financing brand is accepted at over 280,000 provider locations, dental offices, vision centers, veterinary clinics, audiology, dermatology. There is no national competitor with anything close to that network density in healthcare financing. That matters because healthcare spending is fundamentally different from discretionary retail spending. It is non-optional. It grows regardless of macro conditions. When your dog needs surgery, you do not wait for consumer sentiment to improve.
The moat here is partner lock-in and data network effects. Once Synchrony integrates its point-of-sale financing system into a retailer's checkout flow, replacing them means rebranding cards, rebuilding software integrations, and retraining staff. That friction keeps partners sticky for years, and 80 million accounts generate an enormous amount of consumer spending data that feeds back into credit underwriting models, making the network smarter over time. Section 3, CEO Background.
At the helm is Brian Doubles, CEO since February 2021. Tell me about him.
Brian Doubles is as close to a Synchrony lifer as you can find in a company that only went public in 2014. He joined from GE Capital before the spinoff, became Chief Financial Officer of the standalone company, then President in 2019, then CEO in 2021. He spent over a decade at GE Capital, working across consumer finance and commercial lending globally before that. His background is operational and financial. He knows the credit models, the funding structure, and the partner relationships in a way that an outside hire simply could not.
And under his watch?
Under Doubles, Synchrony has navigated the post-pandemic credit normalization cycle. Charge-offs rose sharply in 2023 and 2024 as pandemic-era stimulus faded, and is now executing the recovery. He has accelerated the co-brand card strategy, which puts the Synchrony card on a Visa or MasterCard network with general-purpose use, attracting better credit customers and more interchange income. And on this quarter's call, he announced the $6.5 billion share repurchase program, one of the most aggressive buyback programs in the company's history, at a valuation of 7.5 times trailing earnings. Section 4. The numbers.
All right, Lana, the numbers. Walk me through it.
Q1 2026 net interest income was $4,635 million. Net income was $805 million, up 6.3% year-over-year. Diluted EPS was $2.27, beating the $2.20 consensus estimate. Purchase volume, the amount consumers actually spent on Synchrony cards, hit a record $43 billion in the quarter, up 6% year-over-year. Co-branded and dual cards now account for 51% of total purchase volume. The net interest margin, annualized net interest income divided by loan receivables, is approximately 20.7%. That is high. Credit cards charge steep interest rates on revolving balances, and Synchrony earns that spread minus its funding costs. Operating margin on a trailing 12-month basis is 25.4%. Net margin is 25.2%. Return on equity is 21.8%. These are genuinely strong profitability metrics for a consumer lending business.
And the most important number, the charge-off rate.
Net charge-offs were 5.42% of average loan receivables in Q1 2026. That compares to 6.38% in Q1 2025, an improvement of 96 basis points year-over-year. 90-plus day delinquencies also declined to 2.28%. The trend is clearly improving, and management guided for full-year charge-offs to be below 5.5%.
Valuation?
The stock trades at 7.47 times trailing earnings. Forward price to earnings is about 8.5 times on consensus FYY 2026 estimates of $9.23. Price to book is 1.63 times. Enterprise value to EBITDA is 5.85 times. Market cap is $28.3 billion at a stock price of $78.58. These are remarkably low multiples for a business generating 21% return on equity with improving credit trends.
What about the balance sheet?
Synchrony is a bank. The balance sheet looks different from an industrial company. Total assets are $121.5 billion. The primary asset is $89.7 billion in loan receivables, the credit card portfolio. Cash and liquid assets are $20.6 billion. Total liabilities are $105 billion, predominantly customer deposits at Synchrony Bank and term borrowings. Equity is $16.5 billion. The company's balance sheet leverage is by design. It is a bank model funded by deposits.
Capital returns?
In Q1 2026, Synchrony returned $1 billion to shareholders, $900 million in share repurchases, and $104 million in dividends. Then the board authorized a new $6.5 billion buyback program. At $78 a share, that is roughly 83 million shares, or about 23% of shares outstanding. At 7.5 times earnings, every dollar of buyback is buying significant future EPS. The dividend yield is 1.5% on top of that. Overall, Synchrony's financial health is solid. The earnings are real, the credit improvement is genuine, and the capital return capacity is substantial. But the balance sheet leverage, the regulatory overhang, and the cyclical nature of consumer credit keep this from being a clear-cut strong. Section 5. What the Street Thinks.
What does Wall Street think about SYF?
The consensus is buy. 23 analysts cover the stock, 16 buy ratings, 7 hold, 0 sell. Average price target is $86, representing about 9% upside from the current price of $78.58. The target range runs from $71 on the low end to $103 at the high.
Notable calls?
Barclays has Synchrony at overweight with a $95 target. Wells Fargo is overweight at $92. Evercore ISI is outperform at $90. Bank of America has a buy with a $100 target. They raised the price target after Q1, citing stronger than expected purchase volume trends. JP Morgan is neutral at $80. Truist is hold at $72. The bull-bear divide is essentially about how quickly credit quality continues to normalize and whether the CFPB late fee rule becomes law.
And the Q1 report itself, how did the street react?
Stock was up approximately 6% on the day. The EPS beat of 3.2% was solid, but the market was really reacting to two things: the 96 basis point improvement in charge-off rates and the $6.5 billion buyback announcement. For a stock that was trading at $46 less than a year ago, this combination of improving fundamentals and aggressive capital return was a meaningful signal. Section 6. The bull and bear case.
Let's lay out both sides. I'll start with the bull case.
Go ahead.
First, the credit quality inflection is the defining catalyst. Net charge-offs fell nearly a full percentage point year over year. If this trend continues, provisions normalize, earnings grow, and consensus estimates prove conservative. The market is still pricing in elevated credit risk that may no longer exist. Second, the $6.5 billion buyback at 7.5 times earnings is capital return mathematics that is hard to ignore. Synchrony is effectively buying back 23% of its own market cap at what management clearly believes is a distressed price. Every share retired compounds per-share earnings for the remaining shareholders. Third, Care Credit is structurally undervalued as a business. Healthcare is non-discretionary. When a patient needs dental implants, cataract surgery, or a pet emergency, they need financing immediately in the provider's office. Synchrony has the only national-scale healthcare financing network to serve that moment. Fourth, co-brand expansion is improving the portfolio mix. When co-brand cards make up 51% of volume, the customer base is wealthier, the interchange economics are better, and the credit risk is lower than legacy private label. The business is gradually becoming higher quality. And fifth, the valuation is historically cheap at 7.5 times trailing earnings. Synchrony has not traded at this kind of discount to the S&P 500 since its early post-spin-off years. If credit quality continues to normalize, a multiple re-rating toward 10 to 12 times could drive significant upside alongside earnings growth.
All right, the bear case.
Let's hear it.
First, the CFPB late fee regulation is the single largest known risk. The Consumer Financial Protection Bureau's proposed $8 cap on credit card late fees is currently stayed by federal courts, but the legal outcome is genuinely uncertain. If reinstated, Synchrony could lose $1 to $2 billion in annual fee income, a significant hit to a company generating $3.6 billion TTM in net income. Second, partner concentration creates binary risk. A handful of major retail and healthcare partners drive a disproportionate share of revenue. The loss of one large partner, through bankruptcy, competitive bid, or insourcing, could permanently impair the affected loan book and fee income. Third, credit quality improvement may be cyclical, not structural. Consumer credit normalization has been uneven across income cohorts. A recession, an unemployment spike, or a sustained reduction in consumer spending could quickly reverse the NCO improvement and send provisions surging. Fourth, funding cost sensitivity. Synchrony Bank funds its $90 billion loan portfolio primarily through retail deposits. In a higher-for-longer rate environment, deposit repricing increases funding costs and compresses net interest margin. Q1 interest expense was $968 million. That number is sensitive to rate changes. And fifth, buy now, pay later platforms are applying structural pressure on the private label model. Affirm, Klarna, and Apple Pay Later are increasingly integrated into the same checkout flows where Synchrony's store cards compete, particularly in electronics, apparel, and home goods. These platforms have lower friction and no annual fee, and they appeal to the younger consumers who are increasingly avoiding revolving credit cards altogether. Section 7. Peer Comparison.
How does SYF stack up against its peers?
The most comparable pure-play peer is Bread Financial, ticker BFH, which is the other major private label credit card issuer. Bread trades at about 5.5 times earnings and 0.8 times book, cheaper than Synchrony on both measures. That discount reflects Bread's smaller scale and less diversified partner base.
And on the larger card issuers?
Capital One, ticker SYF, is completing the acquisition of Discover Financial, which makes it the largest general-purpose card issuer in the U.S. Capital One trades at about 11 times earnings and 1.4 times book. Synchrony's deeper discount reflects the CFPB overhang and the private label concentration risk that SYF does not have at the same magnitude.
American Express.
American Express trades at about 19 times earnings and 12 times book, a dramatic premium. That is the Amex brand moat and the premium cardholder demographics at work. Synchrony serves a much broader income distribution, including customers that AXP would not underwrite. That is both the risk and the opportunity.
So Synchrony is the value play in the consumer credit sector.
Definitively. It is trading at half the multiple of Capital One and a fraction of American Express, with improving credit quality, a massive buyback program, and a healthcare financing franchise that no one else has replicated at scale. Section 8. Options activity.
Let's look at the options market.
Post-earnings implied volatility is at the 32nd percentile. The pre-earnings spike has mostly deflated. Current IV is 38.5%, which is elevated relative to the market, but consistent with Synchrony's higher beta of 1.38 and its credit cycle sensitivity. Put-call ratio is 0.68, slightly elevated, reflecting residual hedging on CFPB regulatory risk.
Where is the open interest concentrated?
The $75 put strike and the $85 call strike carry the highest open interest. That tells you the market sees $75 as near-term support. Meaningful institutional hedging is anchored there, and $85 as the first upside resistance, which is just above the consensus price target average. The $85 level also aligns with where Synchrony traded before the 2024 credit quality concerns accelerated the sell-off. As always, options include hedges alongside directional bets. Section 9. Insider activity.
Any insider activity worth flagging?
Routine selling. 4 transactions in the past 6 months. All sales, 0 buys, approximately 22,000 net shares sold. CEO Brian Doubles and other executives have made programmatic 10b5-1 plan sales consistent with compensation vesting schedules. The absence of insider buying is unremarkable. The stock is up significantly from its 52-week low of $46, and since Synchrony's primary capital return mechanism is the $6.5 billion corporate buyback, not individual insider purchases. Section 10. Risks and watch points.
Key risks and watch points.
4 to monitor closely. First, CFPB late fee litigation outcome. Any adverse ruling reinstating the $8 cap would be the single largest near-term earnings risk. Second, net charge-off rate sustainability. If NCOs reverse higher in Q2 or Q3, the credit quality story unravels quickly. Third, purchase volume growth. Slowing spend would signal weakening consumer demand and potentially rising future credit stress. Fourth, partner renewal and loss risk, particularly in the retail segment where store card partnerships face competitive pressure.
Next.
The net charge-off rate is the most important metric to track every quarter. Watch it against the 5.5% full-year guidance. 30-plus day delinquencies are the leading indicator. They predict future charge-offs by 90 to 120 days. Purchase volume growth shows whether the consumer spending engine is still running. And net interest margin trend tells you whether funding costs are compressing the spread.
Forward catalysts.
Q2 2026 earnings in July. The first real test of whether the charge-off improvement is durable or a one-quarter anomaly. Federal Reserve rate decisions in the coming quarters, which directly affect Synchrony's deposit funding costs, and any announcements on major partner renewals or new program launches, particularly in the healthcare space where Care Credit has more room to grow. Section 11. The bottom line.
Let's bring it together. The verdict on SYF.
Synchrony Financial is a deeply discounted consumer credit company in the middle of a credit quality recovery. The $6.5 billion buyback at 7.5 times earnings is one of the most aggressive capital return programs in the sector. The Care Credit platform is a genuinely durable franchise. The risks are real: CFPB regulation, partner concentration, consumer credit cyclicality. But the fundamental trajectory in Q1 2026 is clearly improving.
And the key metrics every SYF watcher needs to track: the net charge-off rate and purchase volume, published every quarter with earnings. If NCOs come in below 5.5% for the full year and purchase volume continues growing in the mid-single-digit range, the credit quality recovery is on track. Watch the 30-plus day delinquency rate between earnings. That is the canary in the coal mine that will tell you what charge-offs will look like 90 days later. Section 12, closing quote plus CTA. We close every episode with a quote. For Synchrony Financial, a company repurchasing its own stock at 7.5 times earnings, essentially saying the market has mispriced its value, this one is perfect. From Warren Buffett: price is what you pay, value is what you get.
And that is Synchrony Financial's entire capital return thesis. At 7.5 times earnings, they believe the value is substantially higher than the price.
That's going to do it for this episode of Charged Alpha on Synchrony Financial. And hey, If you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas. Section 13, Outrow Required Disclosure.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.